Hey guys, Justin Colwell. I'm coming to you here on my front porch during a thunderstorm, but I really want to talk to you guys about risk. I'm risking myself to teach y'all something in a thunderstorm on my porch, right? So there we go. Video over. Just kidding. Stay along with me. Because what I'm really trying to tell you all about is how fundamental risk is to any investment that you're going to be trying to get into, whether that's in real estate or the securities market, stocks and bonds. There are some forms of investments, if you can call them that really, well, I guess you can't call them investments, I don't know why I said it like that, that have very little to no risk. I mean, historically, in modern history of the United States government, they have no risk, and that's treasury bonds and CDs. These are backed by the government in different ways, but nonetheless backed by the United States government. So unless there's like World War III and, you know, a world-changing event where most likely any investment you have is not going to be safe, those are the only times that those wouldn't be safe. But let's talk about this in what most people would maybe understand. And let's say you're buying a single-family house, right? Essentially, in most markets, most places, there's, I mean, you know, no market is the same. Every market is different and unique. I mean, it doesn't matter whether you're talking about Amarillo to Lubbock. Can be very similar on paper, but they're not. You buy a single family house, right? And the risk you're taking is that essentially you're putting all your money into that one asset, and it's illiquid, right? So you can't move it very fast. I mean, you know, someone's going to get on like, well, I sell houses in 2 days. And it's like, well, that's great, man. Good for you. But, you know, on average, right, it's going to take at least fast as 45 days to sell a house in like normal conditions, not between like, you know, savvy investors and not having the right, you know, title companies and, you know, and all that jazz, right? But most likely, by the time, you know, you pay for repairs, you pay for your insurance, you do amortization on your expenses over, you know, the lifetime of that house, you're hoping to make about 5% on a single family residential. And the thing is that your money, it's not very risky to own a single family house, right? It's probably the next step above having your money in a CD or, you know, or a treasury bond. Depending on what your philosophy is on the stock market, you could either say it's a little bit more risky or a little less risky than you know, any given stock, a blue chip, you know, company. You know, I'm not even going to say one because then again, someone's going to be like, well, you said Microsoft, and I don't think Microsoft. They're evil. Bill Gates is evil. And it's like, all right, dude, I get it. You know what I'm saying? I feel you. I'm there with you. But my point being is that you can't expect out of every asset type to make these large returns without the risk being present, right? So when you look at a single family home, there is an opportunity maybe to make some more money or make a higher return, but with that risk present. So what could that look like? Well, in some ways that could be buying a house that needs significant repairs, and you're essentially putting that risk on you that you're going to repair that, and your outcome, whether that is to flip the house, to sell it, or to rent it out, that you're going to make a better return by taking that risk on, right? But so you might get that 7 to 10%. I mean, we have properties that we make 15% on, but we took a considerate risk. You take that to the next level, right? When you get into, other assets of other asset classes in real estate. You're talking commercial, multifamily commercial. You know, for example, you know, one of my home runs was we purchased a motel in Claude. It was a pretty big, significant capital expense into what most people would think is a terrible investment. Why would you want to own a motel in Claude, Texas? Well, you know, I keep my ear to the ground all the time, so I knew the AI data center was coming. And I know people are like, well, I did too. It's like, but did you? Like, did you know it was coming? Because we bought it before it came, right? We were banking on that. So if it didn't come, you know, that was the risk we took, right? Like if Google didn't come and put their money in bring these workers in, our return on that property would have been maybe not as good as what it is now, where we're close to a 30% plus. I don't like to put too many numbers on it. There's a lot of moving parts with a you know, short-term rental type situation we're in there. And maybe I rambled too much in this video, but I think what I just really want people to know is that any investment brings a level of risk, right? Or it wouldn't be an investment. It would just be, you know, if anyone could say, I have $1 and it's going to be worth more, and you could just hold on to your dollars, then, you know, everyone would do that and there wouldn't be an economy. So, you know, no risk, no reward. Hopefully you took something away from this. Maybe I'll get a little bit better. This is like my first set down and talk out my experience in investing in the investment world as an asset manager, property manager, all the things that I do. So hopefully, you know, someone will get something from this video, and I'll continue to do them.